All right, we're working. All right, happy Monday. Welcome to another Lunch and Learn with Purse Strings. If you are new here, Purse Strings comes in every week to provide tips, tricks, pieces of advice on how to be financially fearless. Today, we're going to kind of be breaking down mutual funds and what the heck they are. And then when you're ready to go put things in transition or transaction, you might want to start investing, you might get divorced, you might be getting married, you need a will and a trust. We have top tier financial professionals willing, ready, and able to serve you. We call those our Purse Strings approved professionals, and Brittni here is one of them. So we're so excited to bring her on and have her share her expertise about mutual funds. But before we dive into all of that, Brittni, could you give us a little intro of who you are and what you do?
Thank you. Yeah, so I call myself a holistic financial planner. I use the word holistic in a couple different contexts. One is the licenses I hold. So I do everything in the financial plan from investing. So we're going to talk about some investing stuff today. And also risk management, things like insurance, the stuff that people don't always want to talk about, but is super important. So do know I can help on all ends of that. But I also use the word holistic because money touches so many other parts of our lives than our bank accounts or our pocketbooks. And so for a lot of my clients, the conversations are about how money makes us feel and like what money empowers us to do and in what areas of our lives are we not showing up for ourselves and how is what we're earning or what we're building in relationship to that. So it's a lot more than just, like I said, numbers on a page. But I am a financial planner. I have fiduciary responsibilities, so I am serving that purpose obviously with my clients, but also the conversations I think expand a little bit more than
I
that as
love
well.
that. Yeah, because money is so much more than the numbers. It's almost everything but the numbers after a point.
Yeah.
So I'm so glad, yeah, you have this holistic picture. So we're excited to dive into mutual funds today and kind of learn everything that you need to know. If anyone's tuning in and has any questions along the way, they can throw them in the chat. And just as you know, we like to note that this is just some general knowledge or information. You should definitely talk to either Brittni or another Purse Strings approved professional before you dive into any of this personally. We're just trying to give that base knowledge to get everyone, get those wheels turning, get some of that good information going around. But yeah, make sure you talk to a professional because everyone's situation is unique. None of us are cookie
Mhm.
cutters. So we want to make sure it's the right fit for you as an individual.
Thank
But
you.
yeah, diving into that, let's just get started of like, what are mutual funds? What is this?
Yeah. I first also want to say, like, education is power. So everyone
Yeah.
that's on this today and learning more and getting more educated, kudos to you, because I think the more we understand these pieces in our plan and how they work, the more empowered we can be about taking ownership or co-owning the plan with an advisor if you're working with an advisor. And I always tell my clients, like, I want you to ask questions. I want you to know what this is. Don't just say yes to me. Like, please ask questions. Let's engage, because I want to make sure that my clients understand each piece. So, the word mutual fund, and I think a lot of the words we're going to use today, I don't know if some of you feel this way, but you might hear the words and you're like, I understand what this context, but when those words are put together in the context of finances or financial planning, what exactly does that mean? So hopefully we can break down some of that for you today, so you all leave here with a really good understanding of what mutual funds are.
Yeah.
So I guess first and foremost, I want to start the conversation of mutual funds with kind of like a basic understanding of overall investment philosophy, right? I think a lot of us on the call have probably heard sayings like, don't put all your eggs in one basket.
Mhm.
Diversification is really important. And so, a mutual fund is a tool or a method by which we gain greater diversification in our overall portfolio, right? If we each have $100 to go into the stock market and buy something in the stock market each month, or let's relate this to going to the grocery store, right? If we have a $50, say, or $100 to take to the grocery store, we have a finite number of things that we can buy in that trip to the grocery store, right? But if we are pooling our resources with everyone on our block or everyone at the school or something like that, then obviously we can go to the store and buy a lot more things, right? Because we're
Right.
pooling all the money together, and that gives us an opportunity to spread our money out and buy a lot more things. So that's the concept of a mutual fund, right? I think mutual funds, we all agree that diversification is a good idea. We don't want to put all of our eggs in one basket. And so what mutual funds are at a basic level is an opportunity for us to all pool our money and our resources together. And then we're hiring essentially this group of people to be stewards of our money, to then go to the stock market and say, hey, we are stewards of these people's money. We have this amazing buying power now that we've pooled all of these resources together. And now we can buy a little bit of everything that meets the definition of what this group of people wants to be a part of, what they want to be buying, right? So there's mutual funds that are focused on different sectors of the economy. There's mutual funds that might be social impact driven, right? There's mutual funds for each different asset class in the economy, right? We have large cap, mid cap, small cap. Those are all the different size companies in the US. We have international, established, international emerging. We have commodities, real estate. We have all these different asset classes that we can go and own something in. And there's even different mutual funds within those classes. And then even along the risk tolerance spectrum, right? There's different mutual funds if you're a balanced investor versus an aggressive investor. So there's really like different flavors for everyone and every purpose that they're trying to, serve in their plan. What their need is, there's different types of funds to help them reach their goals depending on what their goals might be.
And so how do you kind of implement these? I know you don't go gather your group of friends and say, hey, we pooled this money, Brittni. Can you do something with it? How does that kind of work?
Yeah, so mutual funds are traded on the stock exchange, on the stock market daily. So if you want to take part in a mutual fund, you can, open an account with a Vanguard or Fidelity or a Schwab if you want to do it yourself. Or you can work with a financial planner and get access to mutual funds through your financial planner. And you can go in and you can research them using a group like Morningstar. I think that's really important because I hear people kind of get confused in my client conversations that I have, that they'll say something like, "Oh, well, I heard mutual funds are good, so I just invested in X." And as I said earlier, mutual funds get us greater diversification, but each mutual fund has a different purpose depending on like the objective of that specific fund, right? And so you really need to, as the consumer, understand what that fund's objective is, because if you're like not an aggressive investor, if you're balanced or more conservative, you don't want to be putting your money in a very aggressive mutual fund if that's not what your risk tolerance is, right? And so first and foremost, I think you need to make sure you're doing your research, and Morningstar is a great tool to do your research on. But you can, just open an account and buy on the stock market yourself, or you can work through a planner like me or another one of the purse string approved planners and build out a portfolio of mutual funds with the planner guiding you.
Awesome. And so how would you know if this is like a good fit for you? I know, and if anyone missed our other video about risk tolerance or like a risk assessment, we talked about that earlier this month to kind of figure out, where you are on that spectrum. But how do you kind of figure out, this is a good fit for me and my investing plan?
Yeah, I mean, I think it all comes down to your goals. I mean, Warren Buffett uses mutual funds, ETFs, and index funds in his own portfolio, and he arguably has enough money to self-diversify, right? Like he has enough money to take to the marketplace and say, hey, I'll build out my own portfolio. But Warren Buffett is saying, like, I don't want this to be my day job. I want to hire other people to do those types of decision making, for me. And so that's why he puts his money in whatever mutual funds, ETFs, index funds. I'm not saying that's the right thing for you, but I'm just trying to say that, I think mutual funds, the right mutual funds are a good fit for a lot of us who don't have the buying power that a mutual fund would have in the market. So to build out a diversified portfolio, a lot of us actually have access to mutual funds simply in our 401ks. If you're investing in a 401k at work, more likely than not, the options that you have to choose from are actually mutual funds. and not single stocks, right? Not single
Right.
equities. You're not going on and only buying Amazon stock in your 401k. You're probably putting your money in something called a target date fund, which is a specific mutual fund that's tailored to your specific retirement date. And over time, it's going to get more conservative as you get closer to your retirement date. So a
Right.
lot of us are probably already invested in a mutual fund if you're participating in your employer's 401k plan. Are you in the right one? I don't know. It depends on what your options are. Depends on what your options are, right? Because not everybody has the same options. That's a decision that your employer is making on your behalf.
Right.
And it depends on, again, like what your risk tolerance is if you attended that session earlier. And it again depends on what your overall goals are for
Right.
if it's retirement or if you're saving to buy a home. All of that stuff is timeline and risk tolerance are all kind of built into the calculation of figuring out, well, what's the right mutual fund for my clients? Those are conversations that we dive into really deeply because you might be a risky investor, but if your timeline's only 3 or 5 years,
Mm-hmm.
you might want to dial back your risk a little bit because you don't have as much time in the market to make up the difference if things are volatile, right? So
Right.
those are kind of conversations we go through one-on-one when I work with my clients to design a portfolio for them.
And I love that because we always, people always ask, okay, I have $5,000. What do I do? I have $15,000. What do I do? I'm like, well, what are your goals? What do you have? What do what's your risk? And
Yeah.
it is these different things, not to be complicated or annoying, but there's not that one size fits all. If there was like a blatant answer, it wouldn't be, all these people's jobs to kind of help you with it. It's not like when you go to the
Yeah.
doctor, there's one prescription and that's the pill for anything that you have wrong.
Right.
And so it's so interesting when you talk about it, and there are these different things that you have to factor for. Are you covered with all your life insurance, like you mentioned? If you have kids or all these other moving parts that you need to make sure are there. So it's so important to
Yeah.
have that professional to kind of like. I always think of you guys as like an umbrella, just
Yeah.
like make sure I have everything under my little umbrella.
Yeah. I think the analogy of like diets is a really good one, right? Like
Hmm.
I'm not here to say being vegan or vegetarian or pescatarian or eating red meat or any of those things. Who am I to say what's right for each person? It's going to depend
Right.
on your lifestyle, your performance goals, if you're an athlete, your religious,
Yeah.
preferences or your personal preferences, where you live in the world. Like all of these things get factored into what should you buy at the grocery store. I think we can all agree that like fruits and vegetables and meat and bread and all these things that a balanced diet makes sense. But what a balanced diet looks like for each person is going to be different based on their specific dietary needs and restrictions and all these extra
Right.
things too. So yeah, not to be annoying by not answering the question directly. It just requires a little bit more information, which is actually good, right?
Yeah.
You want someone that's digging in to help you figure these details out and answer some of these hard questions because you want to make sure you're putting your money in the right thing for you.
For you, exactly. And so when, having this conversation before, you talked about mutual funds and then you also mentioned index funds and ETFs. So could
Yeah.
you kind of explain, how those are different or what they all are uniquely?
Yeah. So they're both ways to gain greater diversification with like your single dollar, right? It's kind of a way to kind of like pool, for lack of more complicated terminology, like to pool the money to buy and get access to lots of companies with with only $1 or $100 or $500 a month, right? Where they're different. So mutual funds are considered an actively managed fund. So it's actually managed by people. There's actually
Mm.
people that make up like the board of directors and the asset managers that are actively, it's their job to go to work every day and research all the different companies. They actually go and visit the
Oh, wow.
companies that they're investing in to make sure, like, is their earnings report on par with what's actually going on in the company, right? Are they, if they're making additional investments in other, companies or other regions, is everything making sense? Is it all coming out in the wash, right? Is what they're saying in this report actually how they're running their business and the things that they're doing every day? So
Right.
so there's actual people on the ground doing work to help manage the mutual fund. And at any given time, there might be companies that they're buying or selling out of that, like that group, that club, if you will, that meet the definitions that they're required to sustain for that specific fund, right? If it's aggressive, they want to make sure that all the companies are meeting their aggressive, definitions, their goals, their timelines, their ROI, the returns on investment, things like that, to be a member of the club, right? So that's a mutual fund. Because the mutual fund employs people to manage it, just like any other thing in our lives where human capital is involved, it's a more expensive investment tool. Okay. So there's going to be higher fees mostly on most mutual funds. And this is, kind of a generalization for the sake of definition here, but generally mutual funds have higher expenses. They're managed by actual people. But it's still pooling their money's resources. The other thing that's a little bit different, not to get into the nitty gritty, but since you asked the question and we're all here to learn, mutual funds, the price for mutual funds changes one time a day. So the market closes at the end of the day, and the mutual fund price is set at the end of that market close. And then the next day, if anyone's like, I want to buy into this mutual fund, they're buying into the fund at that price from the day prior until the market closes the next day. So the price fluctuates one time per day. And you can also buy kind of like fractionally into a mutual fund. You can own like bits of a mutual fund rather than the whole fund at a time. So those are some more nitty gritty details about mutual funds. They're managed actively by people. Therefore, their expenses are going to be a little bit higher. Their price changes only one time per day. And I'm sorry, the last one that I had just said was that you can fractionally own different pieces, right? Okay. So ETFs and index funds are more passively managed funds. They tend to they use like more of like a computer algorithm model to follow the behavior, the movement of a certain index. And the S&P 500, for example, is a group of 500 largest companies in the US. We group them all together. That's the index. If you buy an S&P 500 index, you're not actually buying into each one of those companies. You're buying into an index that follows the movement of that group as a whole. So because it doesn't involve as much human capital to make that fund run, it's more computer and algorithm generated. It's generally less expensive. Those also trade. The prices change and fluctuate during the day. So the prices, you might wake up in the morning and be like, this S&P 500 index fund is worth this price, and at the end of the day, it could look very different. And so you'll see that movement during the day. They're also generally a little bit cheaper to buy into, and you own them wholly instead of partially, unlike the mutual fund. So
those are great explanations.
Yeah, that was maybe a lot more than I meant to be, but the main thing to know is that like mutual funds are actively managed, and ETFs and index funds are generally passively managed, and therefore the cost for them is very different. And we can talk a little bit more about specific costs to pay attention to a mutual fund if that's a good follow-up.
Yeah, what is
question you want to like take a breather, because I feel like that was a lot of information.
It was a lot of great information, and I kind of have two questions on that. One is kind of like, should you be aware that one's more actively managed than passively managed?
I think I lost you for a sec, Maggie. You there?
Oh,
can you hear me? Yeah, I can hear you.
Should you be aware that one's more actively versus passively managed? Like, does that play into someone like being worried about it? But also kind of like, what other fees should you just know about mutual funds that are expected? So it's not like, oh, they're just trying to take my money. It's like, no, it's normal.
No, good point. Yeah, so for mutual funds, there's a couple fees to be aware of. Generally, there's two types of mutual funds that are sold to consumers. One is called an A share. And an A share is for anyone with a time horizon of 7 years or longer. So that means you're going to put money in the market, you're going to invest in this mutual fund, and your plan is to not touch it for at least 7 years or more. These types of funds have what's called a front-end sales charge. More language that we all know what these words mean outside of this context, but then when you put them together, you're like, what the heck are you talking about? So it's called a front load sales charge. And that means that I like to call that a toll. It's kind of like a toll. So over here, I live in Philadelphia. If we want to go over to New Jersey, we don't pay a toll to go to New Jersey, but we pay a toll to come back, right? So in an A share, you actually pay the toll to get in the account, right? You pay the fee on the upfront, and then the internal expenses inside each year are going to be much lower. Okay. So that's the A share. It's good if you're investing for more than 7 years. You pay the fee on the front end. The front end fee can range usually around like 4.5% to like 5.75% is about the range of the front end. That means you take the money, that little toll comes off the top, and then you invest the rest of the money in the mutual fund. And then ongoing expenses are internal and they're a little bit lower. The other option is called a C share. That's for investments usually that are less than 7 years. That does not have a front load sales charge, but it has potentially a back end sales charge depending on how long you've been in the mutual fund. But it has higher internal expenses. So, I mean, people are the fund has to generate the income, right, to pay the manager somehow. They're either going to get it from you in the front and charge you less over time, or they're going to get it from you if you're only going to be there a little bit of time. They're going to charge you more each year that you're in there. There may or may not be what's called a deferred sales charge to get out of that C share fund. That varies from fund to fund. Sometimes there's a charge if you're only in there for a year and the fund goes away after you've been in there for more than a year. Sometimes there's more of a fee schedule. So that's just something to look out for. Make sure that you're in the right share. Usually it's A shares or or C shares. They've kind of done away with B shares mostly. But that's the big thing. If you're in an investment account and you're, 35 years old and you're not planning to use that money until retirement and you're in a C share, you need to talk to your investment advisor or someone about that, because retirement's still 25 years away. C shares are for less than 7 years and the internal expenses are higher. So you need to make sure that you're in the right fund for your length of investment time. A shares is more than 7 years. C shares is generally less than 7 years.
And this is why we asked, what are your goals with that money?
This is why you asked. I was going to say, you opened the can of worms. I'm going to give it to you. I'm going to give you everything I can.
But it's important details, because I can see people getting their money, not wrapped up, but putting it away. And in 5 years saying, oh, actually, and it's like, no, it actually has 2 more years. You have to plan accordingly, or whatever that may be. Things are always somewhat flexible, but you also want to know, if you're going to lose part of that reward. If you change things or whatever that is. And that's why you really have to kind of plan. Granted, everything's adjustable, flexible at some point, it's not forever.
There's another part to the fee expense to tell you about. So in mutual funds, when you're buying, so there's a bunch of different companies that do mutual funds, like a bunch of different companies, right? They basically have like loyalty programs for people that have a lot of money with a specific fund company, right? So they call this rights of accumulation. Again, more words that we know what they mean outside of this context, and then they sandwich them together and we're like, we don't know what you're talking about. But it's called rights of accumulation. And essentially what rights of accumulation means is, hey, I've been growing my money with this company, and that gets me access to cheaper fees on the front end of an A share, right? So different companies have different schedules for like how much you need to get to see the discount, but it's kind of like a frequent flyer program or like a frequent buyer program, right? You get the punch card and you get the free, you don't really get any free mutual funds. They're not just giving these things away, but you're getting, what's important is that like, if you have money in an account with one advisor and another advisor and another advisor, and they're all with the same company, you need to make sure you communicate that, because you could be paying less fees. They don't have to all be with the same advisor, but if they're all with the same company, that would earn you a discount on the front load charge on an A share, which could, over time really come up to being significant savings. So
definitely. No, it's great to know about, especially, if you are kind of separated or spread out in that way.
Or if your spouse has money with one person and you have money with another person, because you guys live in the same household, you could be granted rights of accumulation there too. It doesn't have to be all in your name. So
awesome. And then I also have in my notes here about internal expenses.
Yep. So Yeah, we kind of got to that. So the internal expenses on an A share is going to be lower because they're charging you that upfront fee.
Oh, yeah.
And
Okay.
then on the C share, it's going to be higher because there's no fee up front.
Right.
One thing to know about that expense is that the number that you're generally going to see online is an annual number. So you might see an expense that says like 0.65%. Well, it's 0.65 annually, but it's going to be billed to your account on a quarterly basis. So it's going to be that number divided by 4. And then that's the number that's going to be taking a snapshot of your account at the end of each quarter. And that will be billed directly into your account based on what the account value is at the end of each quarter. So
Got it. That's a great point.
Yep.
Wow. We got a thorough definition of mutual funds, exactly what they are and, how to kind of get started with them. Are there any tax implications that we should know specifically about mutual funds, either good or bad, or, warning signs?
Yeah. So taxes are always an important thing to talk about with my clients. As we earn more money, we're usually exposed to paying more taxes. So one thing to note is that if a lot of mutual funds often earn dividend income. So that's income, right? That, say you bought Coca-Cola or J&J or something like that, companies that have been around for a long time, they return value to their shareholders in the form of dividends, which is a share of their profit, right? That gets paid out. So mutual funds can earn this dividend income. If you earn income, even if you don't sell the fund, it's still new income for you that then gets reinvested into the mutual fund if that's the choice that you've made on the account when you set it up. And that is reportable to the IRS as income, as taxable income. You'll get a 1099 from the mutual fund company, and that would be income that would be reportable and added in addition to any of your income that you either get through work or your real estate investments, things like that. So, so that's one thing to be aware of. When I'm working with clients that are high earners, we are looking at ETFs or index funds and some other strategic kind of investment ideas in their accounts. This would be all outside of your retirement accounts, by the way. Your retirement accounts, none of this applies to, but outside of your retirement accounts, just to make things more confusing, just outside of your retirement accounts is where taxes becomes. There's other tax considerations for retirement, but this specific conversation about dividend income applies to non-retirement accounts, and like non-529 accounts, right? So that the mutual funds earn dividends, you will have to pay taxes on that. ETFs and index funds generally don't earn dividend income. And so that might be a more tax efficient route for you, depending again on your personal tax situation. And you should always consult a tax advisor and, all the language that I need to include with that. But when you sell either of them, depending on how long you hold them, you're still subject to either short-term or long-term capital gains, right? That's still going to apply whether you own a mutual fund or an index fund or ETF. But dividend income is going to happen in year, more likely with a mutual fund.
Right. Yeah. There's always taxes. So you just got to know how they're going to work.
Yes.
It's just before, after, during, you just try to understand it, before they come.
Yeah.
I feel like we've covered a ton of great information. Is there anything that we didn't touch on that you want to make sure is shared?
No, I mean, I think you should just do your research and talk to, if you're going to work with a professional, talk to them about what their investment strategy is, right? Some investor or some advisors only invest their clients in index funds or ETFs, and they have a reason for doing that. Some advisors might only use mutual funds. Some people use a blend of both, right? Because maybe it makes sense to pay for the extra hands-on management in some areas of the market, where other areas of the market make sense to not pay for that. So I hope that this conversation has kind of like educated you on how to have a deeper conversation with an advisor, so you kind of know what their philosophy is. And then the last thing I want to say is not all mutual funds are the same. Hopefully I made that point earlier. Not all ETFs and index funds are the same. So again, sometimes I meet people and they're like, well, I heard a mutual fund is good, so I should just invest in mutual funds. And it's like, well, they're good if, and then you use that if to then understand what you should be investing in, right? So so just make sure you do your research and you understand what you're investing in. Mutual funds have a prospectus. So that's a big fancy word that says like, what the heck is this thing? And then it's going to explain it to you, but it won't be, you'll have to click on it likely if you go onto the mutual fund website. So you always want to check out the prospectus that's updated quarterly, to make sure that you understand, what's you're invested in, who's managing it. It has usually those people's faces on there. Another big thing to look into for mutual funds is what's the turnover in the fund. If you think about it, I mean, again, this is a philosophy thing, but people generally keep their money in places where the money's doing well, where things are working well for them, right? And people tend to leave places if they're not happy, right? And so you want to generally be in a mutual fund that has lower turnover, because that gives you, I think, some confidence that, okay, this fund is doing what they said they're going to do. People have confidence in it and they're willing to keep their money invested in that fund. So that's another thing to look at. There's a lot of other questions I'm sure people might have. Happy to be a resource if anyone has questions. And yeah, once we know more about this stuff, as you become educated, I think you become even more empowered in what's possible for you. So I'm glad to hear that people are on the live today, and I know they'll be watching this later. So happy to answer any questions, like I said, people have, and glad to have Purse Strings as a resource for everyone. So thank you, Maggie.
Yeah, of course. I think this is a great way to just start opening the conversation, get those wheels turning, that you had some great resources, right? Just, questions and conversations to ask your advisor when you talk to them to make sure it's the right fit for you, and that there are these different nuances, and fees and things like that. But talk to a professional, talk to Brittni, talk to anybody else from Purse Strings, and they'd be happy to help you with this. And just jump into the conversation, jump into, with talking with your advisor, and let's just get started. I know some of the education can be a little scary, but let's just keep going forward and it's going to be great.
I hope that whoever you're working with, you feel comfortable asking questions. And that's really important, because that's how we learn. So
definitely. Well, Brittni's email has been going through the bottom, so you can reach out to her at brittni.sennett@nm.com. She's also one of our Purse Strings approved professionals, so you could reach out to her off our site, pursestrings.co. And reach out, start the conversation if you have any questions, and be financially fearless. So thank you, Brittni.
Thanks, Maggie. Thanks, everyone. Have a good one.
Talk to everyone soon. Bye.
Thanks. Bye.